Hi guys. Today we will analyze McDonald's stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. The stock has been a good performer in the overall market. There are positive signs in the very recent evolution, but the medium-term picture is slightly mixed. The short-term trend is neutral. The long-term trend is still positive. Support levels are around $252 and $244. Next support levels are around $230, $222 and $204. Resistance level is around $262. Next resistance level is around $270. In the last month the stock has been trading between $242 and $259 range, which is wide. It is currently trading near the high of this range. It may be a good idea to wait for a pullback before considering an entry. The stock has an average volume of 2.8 million. This is a good sign as it is always nice to have a liquid stock. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model, discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around -1% per year, for last 5 years. We see that the average profit margin of the stock has been around 27% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 86% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for McDonald's company: bad, average, and good. First scenario. McDonald's will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 2%. Future profit margin would be a low, 23%. Future free cash flow to net income rate would be a low, 70%. In this case, the fair value of the stock today would be $111. Second scenario. McDonald's will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 4%. Future profit margin would be average, 24%. Future free cash flow to net income rate would be average, 80%. In this case, the fair value of the stock today would be $142. Third scenario. McDonald's will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 6%. Future profit margin would be high, 25%. Future free cash flow to net income rate would be high, 90%. In this case, the fair value of the stock today would be $179. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 10.04. Minimum rate of return. I will use 10%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For McDonald's, analysts forecast growth rate around 5% per year in next 5 years, and future P/E around 26. Again, I will use 3 different scenarios for McDonald's company: bad, average, and good. First scenario. McDonald's will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 2%. Future P/E would be a low, 14. In this case, the fair value of the stock today would be $71. Second scenario. McDonald's will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 4%. Future PE would be average, 18. In this case, the fair value of the stock today would be $109. Third scenario. McDonald's will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 6%. Future PE would be high, 22. In this case, the fair value of the stock today would be $158. As you can see, today the stock is overvalued, $254, even if we expect the company's high performance in future. While McDonald's has a great profitability rating, there are some minor concerns on its financial health. The stock is expected to show a slow growth in the next 5 years, and it's too expensive at the moment. The stock is a dividend aristocrat. I may consider buying the stock for the dividend, when the stock drops below $180. Company's strengths. McDonald's is the world's largest fast food restaurant chain by revenue, serving over 69 million customers daily, in over 100 countries. McDonald's, with its strong digital, delivery and drive-through businesses, will endure a period of weak industry sales better than most other restaurant chains. Technological investments, and the rollout of the firm's loyalty program, leverage McDonald's scale and could positively drive average check and brand affinity. As the low-cost operator in the space, input cost inflation and a protracted recovery in the full-service segment offer McDonald's a chance to gain share in key markets. The company's return on assets of 14% and profit margin of 32% are amongst the best returns of the industry. McDonald's is a dividend aristocrat. The company has paid and raised its dividend for 46 consecutive years. The stock has a yearly dividend yield of 2.17% at the moment. Risks. A key risk is the cost of beef. For example, a 7-9% increase in beef prices would reduce annual EPS by a penny. Since 65% of the company's revenue is generated outside the U.S., unfavorable foreign currency movements have a significant impact on earnings. There are some uncertainties related to the full impact of the COVID-19 pandemic, including current expectations of a global economic recession, on the company's operations in the U.S. and international markets. Wage inflation, particularly in the U.S., could result in an increase in price competition, and additional investments in automation. Declines in brand satisfaction could slow unit volume growth, worsen restaurant-level profitability, and lead to declining attractiveness for potential franchisees. The company has a high debt level. Also, the company has negative shareholder equity, which is a more serious situation than a high debt level. Based on estimates for the next 5 years, the company will show a small growth in revenue and earnings per share. The revenue will grow by 5 to 7% on average per year. The EPS will grow by 8% on average per year. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.